Today I am going to introduce 10 monopoly stocks from 10 sectors. India is one of the fastest emerging economies of the world. India is trying to be self-sufficient in many sectors. Many global companies are trying to invest in India. Everyone knows about IRCTC, but there are many other monopolies in NSE and BSE. If you are new to my channel, please do subscribe. Also check out my playlist, Best Stocks to Buy for the Long Term. So let's get started. First stock from our list is from the auto parts sector. This stock holds 85% market share in the shock absorbers market in India. The Indian auto industry comes fifth in the world. I am talking about Gabriel India Limited. The company dominates in segments such as two-thirds wheelers and commercial vehicles. Gabriel India boasts a diversified product portfolio, including over 300 models of ride control products. With a strong emphasis on OEMs, the company exhibits a strategic channel mix of 81% OEM, 15% replacement, and 4% export. While exports account for 4% of revenues, Gabriel India aims to expand its presence in Latin America, Africa, and North America. Presently, the company owns 7 manufacturing facilities. The support from the government is giving this sector a boost. Established in 1961, Gabriel India has undergone significant transformations to become a key subsidiary of the Anand Group. Gabriel India has played a pivotal role in shaping the market and limiting emissions in the ride control products sector, contributing to environmental protection. Gabriel India's client base includes renowned original equipment manufacturers. The firm's commitment to research and development is evident through its expenditure of 1% of net sales in fiscal year 2022 and collaborations with global entities. Gabriel India's international aspirations include becoming one of the top 5 shock absorber manufacturers globally by 2025. Let's do a basic financial overview. Gabriel India Limited, with a market capitalization of 5,888 crores, operates with a current stock price of Rs 410. The price-to-earning ratio is 38.65, higher than its sector pay ratio of 34.89. The stock price rose 128.23% and outperformed its sector by 85.67% in the past year. In terms of financial health, Gabriel India is almost debt-free. However, the company faces challenges with a lower return on equity of 16.2% over the past 3 years. The financial metrics showcase impressive sales and profit growth at 27.43% and 47.86%, respectively. The share of the promoter in Gabriel India is high at 55%, where the pledging is zero. Let's discuss the strengths and weaknesses of the company. The valuation of the company appears to be overvalued compared to the market average. The company has low debt and is generating positive net cash flow. Additionally, it is exhibiting an increasing cash flow from operations and has a high Piotrowski score. Both API, and DIIs are actively buying the stock, and the promoter pledge is low and not increasing. The company is delivering better long-term returns than the industry average. However, the stock is not currently in the buy zone according to its historical PE, and the company's valuation score does not signal overall affordability. As always, it's crucial to conduct thorough research and consider your investment goals and risk tolerance before making any decisions. The second stock from our list is from the household personal products sector. This company is the biggest supplier of IKEA. I am talking about Caricel Limited. Caricel Limited, formerly Acrisil Limited, is an India-based company which is engaged in the manufacturing and trading of kitchen appliances and accessories. They entered into a strategic partnership with IKEA for manufacturing and supply of composite quartz kitchen sinks for their global requirement. Established in 1987, Caricel has evolved into a powerhouse, manufacturing and trading a diverse array of products, from quartz kitchen sinks to bathroom suites. The company, in technical collaboration with Shockco, has become the largest manufacturer of quartz kitchen sinks in Asia. Notably, Caricel is the sole composite quartz sink manufacturer in Asia with patented German technology. Caricel's reach extends far and wide, with 78% of its revenue generated through exports. The product breakdown includes 52% quartz sinks, 13% steel sinks, 11% appliances others, and 25% solid surface sinks. Recent acquisitions include the United Granite LLC, a Virginia-based company specializing in kitchen tops. Caricel's international arm, Caricel Products Limited, has a strong presence in the UK, with aspirations to expand to over 70 countries in the next 3 years. Caricel is set to explore new territories and provide innovative solutions in uncatered geographies. Let's do a basic financial overview. Caricel Limited, with a market capitalization of 2,319 crores, operates with a current stock price of 865. The price-to-earning ratio is 45, lower than its sector pay ratio of 71. Stock price rose 75.32% and outperformed its sector by 7% in the past year. Caricel's profit growth has seen a downturn of negative 50.35%, although the company has delivered a robust 34.4% CAGR over the last 5 years. Median sales growth over the last decade has been at 19.4%, showcasing stability and long-term growth. Caricel has faced a sales growth contraction of negative 13.48%. Caricel has a DE ratio of 0.54, which means that the company has low proportion of debt in its capital. The share of promoter in Caricel Limited is at 43%, where the pledging is zero. Let's discuss the strengths and weaknesses of the company. The current valuation of the company appears to be higher than the market average, as the current price surpasses its intrinsic value. However, it is a favorable time to consider the stock since it is not in the overbought zone. Additionally, the company exhibits positive indicators such as low debt, positive net cash flow, and increasing cash from operations. On the other hand, it lacks a high Piotrowski score, and its long-term returns do not outperform the industry. Despite the absence of a high Piotrowski score, the stock is being actively bought by EBI, EPI or DIIs, and the promoter pledge is low and not increasing. Contrary to historical PE trends, the stock is not currently in the buy zone, and the overall valuation score suggests limited affordability. Third stock from our list is from the breweries distilleries sector. This stock holds 52% market share and leads the domestic Indian market in this sector. I am talking about Sula Vineyards Limited. Sula Vineyards Limited is an India-based wine producer and seller. The company is engaged in the business of manufacturing, purchasing, and sale of alcoholic beverages, such as wines and spirits. The company operates under two categories of business: wine business and wine tourism. Incorporated in 2003, Sula Vineyards Limited is India's largest wine producer and seller. The revenue breakup includes a significant 84% from own brands, 8% from imports and another 8% from wine tourism business. The company has a 60% market share in the elite and premium categories and an overall market share of 52% in the Indian wine industry. The company has a presence in 25 states and 6 union territories in India. It also entered the overseas markets in 2003 and currently offers wines in over 20 countries. The company is trying to increase wine awareness and consumption and trying to enter Tier 1 and 2 cities in India. Let's do a basic financial overview. Sula Vineyards Limited, with a market capitalization of Rs 3,892 crores, operates with a current stock price of Rs 461. Price-to-earning ratio is 43.07, lower than its sector pay ratio of 43.35. Debt-to-equity ratio of 0.36 is less than 1 and healthy. Stock price rose 29.06% and underperformed its sector by 6% in the past year. Promoter shareholding decreased by 1% in the most recent quarter to 26.27% with zero promoter pledges. Let's discuss the strengths and weaknesses of the company. The current valuation of the company indicates that it may be overvalued compared to the market average, with the current price exceeding its intrinsic value. Nevertheless, it is an opportune time to consider the stock as it is not in the overbought zone. The company boasts positive financial indicators, including low debt, positive net cash flow, and a consistent increase in cash from operations. Additionally, it holds a high Piotrowski score, reflecting strong financial health. Institutional investors, EPI, EPI or DIIs, are actively buying the stock, and the promoter pledge is low and not increasing. While the company does not outperform the industry in terms of long-term returns, historical PE analysis suggests that the stock is not currently in the buy zone. Despite this, the overall valuation score signals limited affordability, and there are no active positive breakouts observed in the stock. The fourth stock from our list is from the auto sector. This stock is a monopoly in off-highway tire manufacturing. I am talking about Balkrishna Industries. This stock is an India-based company that is engaged in the business of manufacturing and selling off-highway tires, OHT, in the specialist segments. For over 30 years, they have specialized in segments such as agriculture, construction, industrial applications, and much more. Operating in 160 plus countries, they have established a strong distribution network in Europe, America, and Australia. Impressively, 46% of their sales come from Europe, showcasing their dominance in the international market. Their product portfolio spans across agriculture, industrial, construction, earth-moving, mining, and even gardening applications. Let's do a basic financial overview. Balkrishna Industries, with a market capitalization of Rs 50,464 crores, operates with a current stock price of Rs 2,609. Price-to-earning ratio is 48.35, higher than its sector pay ratio of 34.89. Stock price rose 32.63% and underperformed its sector by 10.83% in the past year. Debt-to-equity ratio of 0.44 is less than 1 and healthy. Promoter shareholding is at 58.29% with zero promoter pledge. Let's discuss the strengths and weaknesses of the company. The current valuation of the company indicates that it may be overvalued compared to the market average, with the current price exceeding its intrinsic value. Nevertheless, it is an opportune time to consider the stock as it is not in the overbought zone. The company boasts positive financial indicators, including low debt, positive net cash flow, and a consistent increase in cash from operations. Additionally, it holds a high Piotrowski score, reflecting strong financial health. Institutional investors, FII, EPI or DIIs, are actively buying the stock, and the promoter pledge is low and not increasing. While the company does not outperform the industry in terms of long-term returns, historical PE analysis suggests that the stock is not currently in the buy zone. Despite this, the overall valuation score signals limited affordability, and there are no active positive breakouts observed in the stock. The fifth stock from our list is from the finance sector. This stock holds 59% market share in depository business. In fiscal year 21, this company became the first depository with more than 3 crore demat accounts. I am talking about Central Depository Services, India, Limited. This stock is engaged in providing depository services, data processing services, and others. The company operates through 3 segments: depository segment, data entry storage, and repository. The company facilitates holding and transacting in securities in the electronic form and facilitates settlement of trades executed on stock exchanges. They also have the largest number of DPs registered in the depository business. The company has 592 DPs servicing across 28 states and 8 union territories. Looking at the company's revenue breakdown, annual maintenance charges contribute 34%, transaction charges 13%, and KYC service 16%. Let's do a basic financial overview. CDSL, with a market capitalization of 18,934 crores, operates with a current stock price of 1,812 rupees. Price-to-earning ratio is 59.14, higher than its sector pay ratio of 45.71. Stock price rose 47.83% and underperformed its sector by 6.73% in the past year. Debt-to-equity ratio is 0 as the company is debt-free. Promoter shareholding is at 15% with zero promoter pledges. Let's discuss the strengths and weaknesses of the company. The current valuation of the company appears to be overvalued compared to the market average, with the current price exceeding its intrinsic value. However, the stock is not in the overbought zone, suggesting it may be a good time to consider. The company has demonstrated consistent profit growth in the last 8 quarters. Despite not experiencing consistent sales growth and not having a high trendline durability score or Piotrowski score, the company stands out in terms of financial health, as it has low debt. Shareholder value is evident through a strong return on equity, ROE, positive net cash flow, and a consistent generation of increasing cash from operations. Furthermore, institutional investors, FII, EPI or DIIs, are actively buying the stock. However, promoter stability is uncertain as promoters are not actively buying the stock. In terms of peer comparison, the company outperforms in terms of profit growth compared to the industry median. Regarding value and momentum, the stock does not align with historical PE or PBV for a buy zone, and its valuation score indicates limited affordability. The sixth stock from our list is from the glass sector. This stock is the only producer of solar glass in India. I am talking about Borosil Renewables Limited. This stock is engaged in manufacturing of low iron textured solar glass along with specialty glasses. The Borosil Group comprises 2 independent companies, Borosil Glass Works Ltd and Gujarat Borosil Limited. Borosil Glass Works is the market leader for laboratory glassware and microwavable kitchenware in India. The company has grown by over 7.5 times in the last 5 years. Their products find usage in all laboratories from high-end pharmaceutical production to high schools and colleges. They manufacture products like solar water heater, low-iron solar glass products, lighting products, and consumer products. The company plans to venture into new segments such as glass for greenhouses and BIPV. Let's do a basic financial overview. Borosil Renewables, with a market capitalization of 5,396 crores, operates with a current stock price of 413 rupees. Price to earning ratio is 168.29, higher than its sector pay ratio of 69.59. Stock price fell 23.69% and underperformed its sector by 89.49% in the past year. Debt to equity ratio of 0.45 is less than 1 and healthy. Promoter shareholding is at 61% with zero promoter pledge. Let's discuss the strengths and weaknesses of the company. The current valuation of the company appears to be overvalued compared to the market average, with the current stock price exceeding its intrinsic value. However, it's noteworthy that the stock is not currently in the overbought zone, suggesting a potential opportune time for consideration. Moreover, the company boasts low debt, a strong indicator of financial health. The company falls short in certain aspects, such as lacking a strong return on equity, ROE, and positive net cash flow. However, it is notable that the company is generating increasing cash from operations. Both API and DIIs are actively buying the stock. Additionally, the promoter pledge is low and not increasing. Peer comparison reveals that the company is not currently outperforming the industry in terms of long-term returns. Moving on to value and momentum factors, the stock does not align with historical PE and PBV buy zones. The valuation score does not signal overall affordability. The 7th stock from our list is from the auto ancillary sector. This stock holds 60 to 90% market share in differential gears. I am talking about Sona PLW Precision Forgings. This company is one of India's leading automotive technology companies, designing, manufacturing, and supplying highly engineered, mission-critical automotive systems and components. Their focus on research and development has positioned them as one of the few global companies capable of designing high-power density EV systems with lightweight designs. With 6 facilities in India alone, they supply products to top global PV, CV, and tractor OEMs. This extensive network allows them to meet the diverse demands of the automotive market. The company has secured a strong market position, being among the top 10 global suppliers for differential bevel gears and starter motors. In the domestic market, Sona BLW holds a significant market share, ranging from 80 to 90% in commercial vehicles and tractors to 55 to 60% in passenger vehicles. Sona BLW's geographical presence is truly diversified, with 26% of revenue coming from India and the rest from North America, Europe, and Asia. Their clientele includes major players like Ashok Leyland, Daimler, Maruti Suzuki, and Volvo, showcasing a strong and diverse customer base. Let's do a basic financial overview. Sona BLW, with a market capitalization of 32,741 crores, operates with a current stock price of 558 rupees. Price to earning ratio is 70.74, higher than its sector pay ratio of 34.82. Stock price rose 23.81% and underperformed its sector by 16.96% in the past year. Return on equity for the last financial year was 17.26%. Debt to equity ratio of 0.09 is less than 1 and healthy. Promoter shareholding is at 29.76% with zero promoter pledges. Let's discuss the strengths and weaknesses of the company. The company's valuation seems to be overvalued compared to the market average, with the current price exceeding its intrinsic value. However, it's a good time to consider as the stock is not in the overbought zone. The trendline durability score is high, indicating strong fundamentals, while the Piotrowski score is not as favorable. On the financial front, the company has low debt, ensuring a solid shareholder value. Despite a positive trend in generating increasing cash from operations, the company does not have a positive net cash flow. In terms of ownership, institutional investors, including API or DIIs, are actively buying the stock. In the peer comparison, the company falls short in providing better long-term returns than the industry but excels in both sales and profit growth compared to the industry median. The value and momentum analysis indicate that the stock is in the buy zone based on historical PE, and there is bullishness according to the trendline momentum score. The eighth stock from our list is from the banking and finance sector. This stock holds 70% market share within the mutual fund industry. I am talking about Computer Age Management Services. Established in 1988, CAMS has been the driving force behind India's financial evolution for over 2 decades. Spanning from mutual funds to alternative investment funds and insurance companies, CAMS has established an extensive network of services. CAMS proudly holds the distinction of being India's largest registrar and transfer agent, RTA, representing a substantial rupees 22 trillion with an impressive 69.4% mutual fund aggregate market share. CAMS boasts a physical footprint across India, with 272 service centers strategically located in 25 states and 5 union territories. In terms of clientele, CAMS commands an impressive portfolio, servicing the top 5 mutual funds and 10 of the 15 largest entities. With an average relationship tenure of over 18 years with its top 10 clients, including industry giants HDFC, ICICI Prudential, and SBI Fund Management, CAMS has firmly established itself as a trusted partner. Let's do a basic financial overview. CAMS, with a market capitalization of 13,561 crores, operates with a current stock price of 2,761 rupees. Price to earning ratio is 43.86, higher than its sector pay ratio of 24.16. Stock price rose 17.16% and underperformed its sector by 6.98% in the past year. Return on equity for the last financial year was 36.48%. Debt-to-equity ratio is 0 as the company is debt-free. Promoter shareholding decreased by 0.04% in the most recent quarter to 19.87%. Let's discuss the strengths and weaknesses of the company. Valuation analysis suggests that it may be overvalued compared to the market average, with the current price exceeding its intrinsic value. However, it is noted as a good time to consider the stock as it is not in the overbought zone. Additionally, the company boasts a high trendline durability score, low debt, and positive net cash flow, contributing to a strong shareholder value, including a robust return on equity, ROE. The ownership landscape reveals positive trends with FII, FPI or DIIs buying the stock, low and non-increasing promoter pledge. Peer comparison, unfortunately, does not favor the company in terms of long-term returns, sales growth, or profit growth when compared to industry medians. 9th stock from our list is from the metal sector. This stock holds 85% market share in thermostatic bimetal and trimetal strips. I am talking about Shivalik Bimetal Controls Limited. The company engages in the manufacturing and sales of thermostatic bimetal trimetal strips, components, and a variety of electron beam welded products. Shivalik Bimetal Controls is among the few domestic manufacturers of bimetals and shunts, giving them a unique position in the market. Their proficiency in joining metals through diffusion bonding, electron beam welding, and other methods sets them apart. Shivalik's products are integral to industries such as electronics, automotive, domestic appliances, medical, industrial, agricultural, and animal husbandry appliances. With products exported to over 40 countries worldwide, Shivalik has firmly established itself as a global player in the industry. In the fiscal year 2022, shunt resistors accounted for 52% of the revenue, while thermostatic bimetal trimetal strips contributed 46%. Geographically, America, Europe, India, and others make up the revenue split, with notable growth in the American market. Let's do a basic financial overview. Shivalik Bimetal Controls, with a market capitalization of 3,175 crores, operates with a current stock price of 551 rupees. Price to earning ratio is 39.79, lower than its sector pay ratio of 82.73. Stock price rose 36.51% and underperformed its sector by 34.46% in the past year. Debt-to-equity ratio of 0.22 is less than 1 and healthy. Promoter shareholding decreased by 9.52% in the most recent quarter to 51.09%. Let's discuss the strengths and weaknesses of the company. The company's valuation appears to be overvalued compared to the market average, with the current price exceeding its intrinsic value. However, it is a good time to consider the stock as it is not in the overbought zone. The company has demonstrated consistent sales growth in the last 8 quarters, as well as a trendline durability score and low debt, indicating positive indicators. On the flip side, it lacks a high Piotrowski score and is not generating increasing cash from operations. In terms of shareholder value, the company boasts a strong ROE, positive net cash flow, and increasing interest from EPI, EPI or DIIs. Despite the company providing better long-term returns than the industry and outperforming in sales growth, its profit growth lags behind the industry median. Additionally, the stock does not fall within the buy zone based on historical PE or PBV, and the valuation score indicates overall unaffordability. The 10th stock from our list is from the logistics sector. This stock holds 68.52% market share in cargo carrier services. I am talking about the Container Corporation of India. This stock is a holding company specializing in logistics and transportation services. Operating through two key segments, EXIM and domestic, Concor is at the forefront of handling, transporting, and warehousing activities. Rail is the backbone of Concor's transportation strategy, with the majority of terminals rail-linked. Whether it's warehousing, container parking, or repair facilities, Concor's terminals provide a spectrum of services. As a container freight station, CFA's operator, they add significant value to the logistics chain, offering services like transit warehousing, bonded warehousing, LCL consolidation, and more. Concor boasts a 77% market share in the domestic business and 65% in the EXIM segment. The terminal network is robust, with 60 terminals. From enhancing international presence to investing in IT initiatives, Concor is paving the way for efficient logistics support. Let's do a basic financial overview. Container Corporation, with a market capitalization of 46,724 crores, operates with a current stock price of 767 rupees. Price to earning ratio is 39.14, lower than its sector pay ratio of 90.84. Stock price fell 0.39% and underperformed its sector by 10.42% in the past year. Debt to equity ratio of 0 is less than 1 and healthy. Promoter shareholding is at 54% with 0 pledges. Let's discuss the strengths and weaknesses of the company. The current valuation of the company appears to be overvalued compared to the market average, with the current price exceeding its intrinsic value. Despite not being in the overbought zone, the company has witnessed consistent profit growth over the last 8 quarters. However, the same cannot be said for sales growth. On a positive note, the company boasts a high trendline durability score and a high Piotrowski score, indicating strong financial health and low debt. Shareholder value, as measured by ROE and positive net cash flow, is not particularly strong. Nevertheless, the company is generating increasing cash from operations, and there is notable interest from EPI, EPI or DIIs, as they are actively buying the stock. The value and momentum indicators suggest that the stock is not currently in the buy zone based on historical PE or PBV. Additionally, the company's valuation score does not signal overall affordability. Remember, always conduct thorough research before making investment decisions. I hope you found this video informative, and subscribe to our channel for more informative videos.